Hello everyone and welcome back. My name is Greg Furman and this is the Forex Weekly Outlook for the week of July the 18th, 2016. Now, we're entering into, again, summer trade. Things are slowing down. We're not seeing a lot of the volatility that we've seen as of late, so it should be more range trading, I would say, over the next month and a half. And I don't see any violent moves coming unless we get more economic news or more terror attacks, things like this. But even with that, the market is basically fairly stable right now. Now, to get started, we're going to begin where we always do with the US dollar index. Now, what we can assess here is that basically the trend line that I talked about in last week's Forex Weekly Outlook continues to hold. Now, when we look at that trend line area, again, there's a couple of things we want to take notice here of this particular trend line. Now, we can see that our resistance is all coming in along this upper trend line here. However, the key VantagePoint 18-day predicted EMA, we've tested it and we have bounced off of it. Now, that critical level now comes in at 95.95. Now, that is the key level of support. Our lower trend line here is all the way down at the 93.50 area. I don't see that being retested as of yet unless we continue to fail at this upper trend line area. But the key VantagePoint, again, the key VantagePoint 18-day predicted EMA, if we bring this in, we zoom it in here a little bit closer so everybody can see it, we can assess that, again, that area continues to hold. We've had two tests on Thursday and on Friday of last week, each time a very strong buying opportunity. But to clarify, we must break through this level here at the 96.60 area. Now, we've had a pretty decent retail sales number. That may be enough to help things along next week. We've got the ECB. That's probably going to be a euro killer, I can imagine here. So most things do support the US dollar, at least against, for the time being, the euro, the Swiss franc, the yen, and likely the British pound. Now, our predicted short, medium, and long-term differences and our neural index, the predicted MACD, and the predicted RSI, all telling us that the dollar index is going higher. That's what we're looking for this to continue. So again, those critical levels, when we look at the RSI, we can see the RSI 65.6. We're looking for momentum to continue to build to push the dollar higher. Now, with that dollar going higher, we can also see the high intermarket correlation that the dollar has to the global equity markets. As the global equity markets are going up, predominantly the US dollar is going up against the euro, the Swiss franc, the British pound, the yen, but not necessarily against the CAD, the Aussie, and the New Zealand. They're commodity-based currencies, and commodities have been relatively strong so far in April, May, June, and July of this year. So we can see these equity markets rising higher at the dollar index. This supports the dollar index. With the DAX moving higher, this actually weakens the euro currency. The euro was unable to gain any traction this week. Same as the Nikkei, the yen trying to break out of its range, which we'll talk about in a moment here. But we need to understand what is driving these rallies in the dollar yen. Yes, we have more easing coming into the market from the Bank of Japan, maybe a little bit of currency intervention there. But the fact of the matter is, when the Nikkei took off, the dollar yen took off. That was the driving factor. So as long as these global equity markets are stable, then the dollar yen is likely going to be stable. But in my respectful opinion, not everybody is going to agree with what I'm going to say, is I believe the stocks are grossly overvalued at these levels, and the only reason that these stocks are this high is because we're in a zero interest rate environment. So people are going to stocks, they're going to stocks for, yields of some kind, but I'm not sure that that is going to continue. So we'll continue to monitor it, but again, we have to look, a number of different analysts will argue that the stocks are not overvalued. A number of other analysts will argue that they're grossly overvalued. I'm a little more in that camp. That's about where I'll leave it. Everybody has their opinion on this, but I believe that it's the zero interest rate environment globally that is what is keeping these stocks this high. Now, as we look at our additional commodities that we want to make sure we're monitoring at all times on the intermarket analysis basis is, of course, light sweet crude oil. Now, the key levels that I talked about last week have continued to hold the entire week. We're sitting on this lower trend line at about the 45 area, but the key vantage point level here, 47.39. Once again, we can see multiple retests of that 18-day predicted EMA only for the market to turn and go lower. So we're holding down here right now. Essentially, the way we look at oil for next week, what you should be looking at is essentially we have two things that we need to understand. The market right now is trapped between this lower trend line and this key VantagePoint 18-day predicted EMA. That is the current range we're trading between 47.39 and about the 45.10 area. A break of that area will see a more aggressive move to either the upside or the downside, but right now the indicators from VantagePoint very mixed, and they're actually suggesting that oil could likely move lower. Now, I think the same would apply to gold here in this zero interest rate environment. It's kind of helped gold along. The risk-off scenario has helped gold. But with the better retail sales number and with the equity starting to rise again, gold is again struggling. We appear to have at least a short-term top in place at 1380, corrective move here. But we can see that the market is all tangled up around this VantagePoint 18-day predicted EMA. So what I'm going to do is bring that over so everybody can see this. I'm going to just drag this over so we can get that number. And again, once we have that number, we can see it's 1328. Now we've closed at 1327. Not exactly a bullish setup here for gold, guys. It's going to take some other catalyst to get gold moving again. I think Brexit is in the rearview mirror. We've had a coup in Turkey, failed. I don't think that's going to have any great positive effect for gold. So for now, gold appears to be getting rather toppy, but it's made some decent gains in 2016, indisputably. So can those gains continue? I'm not really sure if they can or not here, guys. We know that the Fed is talking one or two more rate hikes. That's going to let the air out of the equities, and it's going to let the steam out of the gold rally at the same time. Now, as we move into our individual currencies, we can see that the euro here continues to struggle to make any upward movement. Now, once again, when we look at things from an intermarket perspective, not from a Fibonacci, Elliott wave, all of these different wild and wacky theories, the intermarket correlation here is what I've discussed is the DAX 30, and we've got gold prices. Euro is a very high correlation to gold and an inverse correlation to the DAX. So as the DAX strengthens, we can see that the market continues to fail around the key VantagePoint 18-day predicted EMA or thereabouts, basically, but anywhere underneath the 112 area. 111.05 is the current 18-day predicted EMA. We can see we've had a very bearish close at 110.29, and I would expect further weakness on the euro next week based around the ECB. Now, whenever a central bank talks, of course there's going to be volatility here, guys. There's no way around that. But for now, we can see, again, the market just basically running along this key VantagePoint 18, this dark-colored blue line that I've outlined right here, 111.05. We've tested it 1, 2, 3, 4, 5 times, and each time, guys, we have failed. So when we know what these key levels are, it makes it easier. So essentially right now, Euro US is and continues to be a sell into rallies. Now the same thing would apply to US Swiss franc when we look closer at it. This remains a buy into rallies. Now what we're going to do here is we're going to adjust our trend line here so everybody can see. And when we draw this in, we can see that US Swiss franc has been running along this trend line right here, and it's trying to break out below that trend line. So that has happened to some degree. Now, the area that I talked about last week, I'm going to talk about it here again, guys. We've got a very tight wedge formation. What makes me a little bit nervous on this particular pair is that the only thing that appears to be holding this pair up is that key VantagePoint 18-day predicted EMA. We can see the market has tested it 2 days in a row at 97.75, and each day we have rallied off of that by at least 80-90 pips, which is basically 1% of that daily range. Now, I would remain again bullish on this. We can see we've got a predicted MACD crossover. We're above the zero line, and our predicted RSI 64 here, guys. We are not overbought. This is building momentum. When we combine it with the additional indicators, it's suggesting that this trend line up here at this 99 area is going to give way soon. Could it be next week? Yes, it very well could be. Now, again, the ECB is a wild card here, guys. That's the best I can tell you on that one. I cannot predict what these central bankers will do or what they will say. He could indirectly say something to strengthen the euro. We're not going to know that till Thursday, so I wouldn't get too excited until then. And on Thursday, I would maybe stand aside on these two particular currency pairs. Now, with Great Britain, US here, we do have a bottom here for now, is basically where I'm going to leave this, and that's down around the 128 level. The problem that I currently see with Great Britain is the Great Britain currency has a very strong correlation to oil contracts, and oil contracts are losing ground. So we've retraced all the way back up to this key VantagePoint 18-day predicted EMA, and we're failing at this particular level 2 days in a row. And once again, I'm going to bring that level here so everybody can see this. When I drag this over here, it's very easy to assess where this level is. 133.85, the VantagePoint 18-day predicted EMA. Now, once again, as long as we're holding below that area, shorts are favored. If we can get above 133.85, hold above that area, then we could see a bottom in place and we could see the British pound rally. But my optimism on that at this particular time remains heavily guarded. Is the Brexit a big deal? In my respectful opinion, it was never a big deal. It's just, you know, it may not even materialize to anything. So we don't want to speculate too much on that. But right now, I think that the market was maybe a little too much buy the rumor, sell the fact here. And again, we are correcting, but we have to get above 133.85. Now, what I will point out here is that I'm looking for confirmation from the VantagePoint indicators here, predictive indicators, and the predicted short, medium, and long-term differences, and the strength indicator, and the fact that we're failing at this 133.85 still doesn't give me a lot of hope for longs here, but there is some light at the end of the tunnel maybe here. Our predicted MACD is crossing the trigger. Our predicted RSI is holding above 40 but below 50, so we've still got a problem here. And again, we're looking for that break of 133.85. Then we can look to get aggressively long on this, but for now I just don't think we're there yet here, guys. Now, when we come into our dollar-yen pair, what I talked about in last week's Forex Weekly Outlook, and just to remind everybody, you can see that I'm not drawing an actual trend line here. I'm drawing it off the Brexit. We had a big move up and a big move down, and we have had no follow-through on either side of this bar since. Okay? Now, good call from VantagePoint. I will certainly give them that. I'm not sure I would have agreed with it, but once again, the machine has beat me, so to speak. Is that I expected further downside on dollar yen, which we did have some, but we recovered very quickly. Once those global equity markets turned around, I knew we were going to push higher on this. Now, what I want to point out is that, you know, the S&P 500 is making excessive gains here. The Nikkei is recovering. As long as they keep moving up, then the dollar yen will keep moving up. But based around these indicators right now, we have a little bit of divergence here. We can see that our short-term predicted difference is crossing over our medium and long-term predicted difference, and it's heading down. The predicted MACD looks good, but we are still below the zero line, and our predicted RSI is 64.3, which is good, but we're still losing a bit of momentum. The angle of that line is pointing down, so I will be far more comfortable once we clear 106.80. Then I think the pressure should be off the downside on the dollar yen pair for at least the next month or so maybe. But again, predominantly mid to late August, we have repatriation into the yen. I would still be very cautious on this. If those global equity markets sell off, the dollar yen will sell off. That is the key intermarket correlation. If you're trading the dollar yen, you are trading the Nikkei, you are trading the S&P 500, you are trading the DAX 30, the CAC 40, all these global equity markets. That intermarket correlation is still fully in place here, guys, fully in place. So we've got to be careful around 106.80, and we're looking for the equity markets to continue to rally. If somebody said to me, would the S&P 500 be at 2170, I would laugh at and say, no, of course it wouldn't, but it is. And we can argue and debate why it's at this level, but at the end of the day, it is, and it's still moving higher. So until we see some kind of sign of a significant sell-off in the S&P and the Nikkei again, the dollar yen will continue to rise. But if this is a false break higher on the S&P 500, and all they're trying to do is run the short traders out of their positions. That means the dollar yen could be getting, or excuse me, the S&P and the Nikkei could be getting ready to turn lower again. Now, as we come into our dollar CAD pair, this has been a tricky one this past week. Now, with oil prices starting to fall, the CAD is basically enjoying this rally based on a risk-off scenario. The Aussie has rallied, the New Zealand has rallied, the CAD has rallied to some degree. But I don't think that we're really out of the woods here by a long shot here. Now, if we look at this swing low on this trend line, the area, when this is what I'll discuss, what I've advised my own direct clients, is we want to watch the 128.40 level very, very closely. And you can see that we've come down to this level twice over the last couple of days, and the buyers have driven this thing back up off of this level very, very aggressively, to the point that we have actually managed to fight our way back up above the key VantagePoint 18-day predicted EMA, which comes in again at 129.59. So very impressive rally on Friday to take this one to close back up above that 18-day predicted EMA, but we need to hold above 128.20, 128.40 for next week. That's the key levels. Our indicators are turning up. Our predicted MACD holding above the zero line, predicted RSI 51.5. This is suggesting to me here, guys, that we continue to buy the dollar yen, but we're going to have our stops below 128. Excuse me, at the very minimum here. We don't want to be going in and trading anything in the Forex market with 10, 15, 20 pip stop losses in the hopes of getting 60, 80, 100 pips. Trading, guys, for the most part, I hate to break it to you, but it just doesn't work that way. In most cases, we have to identify some critical levels here, and then we have to basically determine who's in charge, the buyers or the sellers. Right now, I believe the buyers are directly still in charge when it comes to US Canada. So if we break 128, then we can look at getting short here. I think if we break through 128.20, 128.40, then shorts will be on the table. But again, looking at that intermarket correlation of the oil contracts struggling to make any kind of move higher, gold down, that's a problem for the CAD, and it could be a problem for some of the other commodity currencies also, specifically Aussie and New Zealand. So right now, again, those are our key levels here. Our intermarket correlations with the CAD are warming up to the long side again, but I did like to see that close above that key 18-day to finish the week. Now, with Aussie, again, once again, I'll discuss that trend line area that I talked about here last week. This area continues to hold. However, so does the VantagePoint critical 18-day predicted EMA. We can see this dark colored blue line here that we're rising up off. 75.14 is the critical level, but we have to get through this staggered resistance on this trend line right in this area here, guys. That's where we need to break through. And you can see the Aussie struggled. Now, it came all the way back down to the 8-day predicted EMA from VantagePoint at 75.56, and that key 8-day predicted EMA continues to hold, but our indicators are warning us here that the Aussie move to the upside is losing some momentum. Now, this big move down was after the retail sales number on Friday, and it is a Friday trading, very choppy. Aussie could turn around and gain momentum to start the week, but there is signs that it is losing momentum. Now, you can see we've broken back through the 60. We're at 55 on the predicted RSI. I was looking for it to hold above 60. So if we break below 50 on the predicted RSI, chances are we are going to retest this 75.14 area and potentially break through down into this trend line area. That trend line area right now is coming in at about the 74.80 mark. So a lot of support for Aussie between the 75.14 area, the key 18-day predicted EMA from VantagePoint, and that lower trend line that I've put in here. So we'll watch it very closely, but be very careful. 74.80 to 75.14, that's the support area. Small longs can be attempted, but again, keep an eye on those commodities. Oil, gold, silver. These are high intermarket correlations, and of course the equity markets. Okay, that means the Nikkei, the S&P 500. If those global equity markets are moving up, the chances are the Aussie is moving up also. Okay, so that's the way we want to look at that. So if we lose the equity rally next week, then the Aussie is likely to succumb to the sellers. And the same thing would apply to New Zealand here, guys. I'm just going to draw this. Let's redraw our trend line in here, shall we? So we get that in so everybody can see it here. This is a bit of a problem here. So when I draw this in, you can see that I've drawn my trend line in here. And I'll just highlight these two areas. I'm taking it off the two swing lows here, which makes up my trend line off of that. But again, I'm drawing my charts from my trend lines, excuse me, from right to left, never from left to right here, guys. I'm taking my trend line off current price, the current swing low, and then I'm going from the right back to the left to connect it to the next swing low. That is creating my trend line. So at this particular area around this key vantage point level, 71.62, we've closed at 71.12. Now, one of the reasons that's putting pressure, more pressure on the New Zealand than the Aussie, is because of that trade we did on Aussie New Zealand several weeks ago. Aussie New Zealand breaking up to the 107 area, which again I suggested would happen on that cross pair. That cross pair is very significant to Aussie US and New Zealand US because there is no such thing as Aussie New Zealand. You have to buy one and sell the other to go into that pair. So it can put pressure right now with that breakout on the Aussie New Zealand up to that 107 area. That put a lot of downward pressure on New Zealand US. So there's a lot of activity going around in this particular area here, but the indicators from VantagePoint are suggesting that it is likely corrective. The move down lower is likely corrective in nature, but at 39.4 right here on the predicted RSI, again, you'll notice how my RSI, I do not have it set up as an overbought and oversold condition. I have it set up to gauge momentum. Case in point, with using a 60-40 split on the predicted RSI, when I break through the 60, and it matches the key vantage point indicators right here. We can see a triple EMA cross right here with the RSI breaking above 60. We are buyers right here, and we have a tremendous move up on this particular pair. Now, these are the kind of moves we look for. So right now, when we break through the 40 level, I can demonstrate here the exact same thing using the VantagePoint software, that when we have that triple EMA cross to the downside, we have a break of the 40 level here, we saw a very significant move from basically the 69 mark all the way down to 67 here before it turned around. And the same indicator that got us short would be the same indicator that tells us to close the short and turn around and go long. Okay, so if we've been going up here on New Zealand US for basically the better part of July, so we could see a significant move to the downside here on New Zealand US, which would be fueled by a number of different intermarket correlations, equity, the stronger Aussie US. All of these things together could cause some problems for the New Zealand currency. So we've got, once again, a busy week ahead next week. I think that we're going to see moderate volatility until we get into the ECB announcement next week, which I believe is on Thursday, and the press conference from Mario Draghi. And what I'll say here, I'll say well, the same thing to my own direct clients, is that we cannot predict what these central bankers will say, what they will do. They always seem to catch us off guard. If they should be going up, they're going down. If they're going down, they should be going up. We don't want to be trading around announcements like that. So be very cautious on that particular event risk.